Hello again, everybody.
Hey, y'all.
Hey, look who's here. First time.
No,
Just you and I.
Yeah,
First
maybe
time.
so.
You were on with our other partner, of course, Brandon, but just you and me.
It's been a while.
First time.
Simon and Garfunkel. They were great early.
Is that what it is?
Maybe they come back.
I kind of like Cronin and Richrath, although
I'm not sure anybody else would get that. I get it.
that shows us how far we've gone back together because we've been to a few
We've been to
REO
a few
Speedwagon
concerts. That is true. We have.
Welcome, everybody. This is my longtime partner. We're talking more than 26 years. Tom Cordes, certified, not certified. I'm a certified guy.
certified.
I'm a CFP, of course, certified financial planner, CFA, chartered. I guess that's more important.
Right.
Chartered financial analyst. All right, my friend.
That's right.
You know, we've been together longer than you've been married.
That is
Think
true.
about that.
That
We've
is
been
true.
married longer
3 years
than
longer.
you have.
Yeah.
That's crazy. Before we get into the meat of this, and we're going to have fun here today, folks. Since we've been together a long time, and we've seen it all. We've seen bear markets, bull markets, everything in between. We're going to talk about 5 things as we put our heads together. 5, I guess, mistakes that investors make routinely. They come up quite a bit, and we're going to get to that. But I just want to have people watching share in kind of the early days when we first started to work together. So this is kind of funny, but so it's early 99, and I am starting to think that maybe in about a year or so, I want to hire my first junior partner. I've been in the business by myself at the time for about 5 years, and our paths crossed. You were a senior at SLU, and majoring in what, and what did you want to do when you graduated?
Gosh, majoring in economics, but I don't think anybody knew what to do with that kind of degree. You know, Alan Greenspan was always like, oh, he's like, the godfather of economics, is the chairman of the Federal Reserve at the time. But I had no idea. Honestly, I had no clue.
Would you have been a teacher?
No. Probably something in banking, finance, maybe. I don't know. Yeah, but there was only like 5 of us who majored in economics at SLU.
Really?
The finance was 50. The marketing people were 100. It's like, oh, all the economics majors stand up to go through the line. I'm like, I looked around. I thought, that's it. There's like 5 of us. That's it.
Funny.
So yeah, here we are.
So I make the offer. That's a whole other story. We've talked about it before. As you're a senior, you're getting ready to graduate. And as we like to tell the story, I had no business even making an offer because I didn't have the money yet, because it was going to come out of my pocket. The firm at the time was not going to pay for it. So I had to lowball. This guy had no business really accepting the offer because you had your colleagues and your friends going off and getting other financial jobs, making more.
Making twice as much.
Yeah.
Twice as much. And back then, you were broke.
I was
broke. Well, you were broke too.
That's exactly right.
You didn't have a lot of business hiring somebody. You had made it though, right? It's not like you were kind of barely making it.
Right.
And I wasn't the reason that you were successful. You were successful on your own before you hired me.
Well,
I just want you went from better to best, from good to better.
I
after
love
you hired
it.
me.
Hey-o.
I don't want everybody thinking here that he's only successful because of me. That's not true. That's not true.
Well,
he was
you're
great
too
on his
kind.
own.
You were too kind.
Great on his own. But yeah, you had no business hiring anybody.
Not at that time. Another year or two.
Yeah,
I did,
yeah.
But not
That's probably
then.
fair. That's fair.
And so, can you articulate why? Why did you say, okay, this guy's making it on his own. There's something there. He can't hardly afford me. I could make more elsewhere. I'm going to say yes to that.
I love the stock market, and when I went to a seminar in January of '99 with my dad, I thought to myself, I just looked at him and I go, yeah, like I can do that. Like that's sort of like me. And when I look back on my life, I had a grass cutting business when I was like 9, 10, 11 years old, bought a CD at the local savings, in my savings account. I never forget they paid me 4%. 4% for 1 year. And I thought to myself, of course, a lot of grasses you got to cut at $12 a yard. I saved $1,000.
Whoa, that's
I
good.
thought to myself, a year from now, they're going to give me $40 for nothing, for no reason other than just holding the money. I started thinking to myself, I was like,
business.
oh my gosh, this is like stealing, right? This is great. Then bought mutual funds when I was 13, 14, 15 years old. And so it's just the natural progression of who I think I ultimately was as a kid. And then when I saw you, I thought, that's perfect. That's exactly what I should do.
Well, we really do play off each other well. We have some similar talents. We do. We both love to research. We're both kind of investing geeks that way. And he and I, and Brandon too, we are constantly texting and emailing each other with our research. But we're also different in that you like to get much more granular. You like to really dig into numbers and data, I think, even more. I tend to kind of like to look at bigger picture. Now, we both do each of those things, but I think we have our skill sets that, and we always do joke, but the whole Lennon and McCartney thing. When they were individuals, maybe not as big, but somehow the synergies got together and they created magic. And, that's sort of what has happened for, 26 plus years coming up.
I know. I always say that I do things well that you don't do well, and
Right.
you do things very well that I don't do at all.
And by the way, the episode, if you haven't seen it last week, go back to it. I talk about one of the things that I'm really terrible at. I know a lot of you are laughing right now. I can't fix or repair anything. You know that well, don't you?
Yeah, because I've been to your house to hang pictures and do other things that you can't do.
I can't do it. So he's proof. If you haven't seen it, go back and look, and you'll get a big laugh. But that gets to it. Okay, so let's get into the meat of this, Tom. We, in all the years that we've been together, there are some commonalities of things that we see with investors. And we're not talking just about clients or anything. This is investors as a whole, in general, as we talk to a lot of folks. So we are now going to do sort of a top 5 in no particular order. Some of them are going to be very obvious when we say this is a common mistake that the average investor makes. Some of them maybe you haven't thought about before. So let's start with an obvious one. The first one, the twin evil emotions of fear and greed. Take that. What have you seen in the years where people really do wrong things at the wrong time?
Yeah, I think part of our job is to try to remove both of those emotions from the plans that we create, the investments that we kind of build for clients. I always think in terms of like we want the highs not so high, but the lows not so low. Kind of like moving those guardrails in a little bit. The more extreme the ride for clients, the more they lose sense of what the plan is for them, what the allocation should be, based on stocks, bonds, cash, whatever. But that's always our job, right? So it's hard to do. It's hard to do in years like 99. It's hard to do in years like 2008. It could be hard to do in COVID years and maybe right now with AI, who knows? But it's always trying to remove the emotion is always our number one goal.
And it's interesting because investors will even say, against my better judgment, I need to do this. And we're talking especially during bear markets. It's painful. It's one thing when things are going really well and people, that's an easy decision to make. Well, I'll just keep buying. It's even more an easy decision when the markets are going down. I got to get rid of this pain. I've got to sleep well at night. I know we're being told by the professionals to hang in there. And by the way, we're not saying that you shouldn't adjust the portfolio.
Right, of course.
Maybe you're too aggressive and you should pull back, but to get completely out. So fear and greed are two of the bigger ones.
Yeah, absolutely. Yep.
For sure. All right. Number 2 on the list, tax implications. When we were first working together, we were more just on the investment side. That's kind of how you start out a little bit. Then you realize after a while, taxes are kind of a big deal.
Yes.
And people make a lot of decisions without even, sometimes people think too much about tax implications. For example, I've got a really highly profitable stock and I just don't want to sell to pay the tax. Well, that could be a mistake.
Of course, yeah. Could definitely be a mistake, yeah. Especially if you think about in terms of, if you got long-term gains, are usually lower rates than short-term gains. So we try to do, we don't give tax advice, we don't do taxes, but certainly tax planning is a big part of what we do.
Yeah, and let's dig into this a little bit more, Tommy. What have you seen, or maybe some advice that you can give to help people think about taxes when they look at investing? What is something that sometimes people overlook in that?
I think something called not just asset allocation, which is how much you have in stocks versus bonds versus other assets like cash, but in particular, something that we call asset location. So maybe you have something that's very tax inefficient, like if you own a certificate of deposit, right, a CD. Owning that maybe in your IRA might be better because you get to keep all of that return, all of that 4% that I mentioned before, whatever CD rates are. If that is owned in a taxable account, that is called ordinary income, right? So all that 4%, you got to pay all the tax on that every single year, which can drag down your performance. But making sure that the right assets are in the right account type is also really important.
One that I did a podcast with Brandon, our erstwhile partner, was on Roth conversions that we did. And that's something else that we always try to inform investors. Yeah, let's look at tax implications today, but let's think about some of the decisions that we're making that will have an impact 10 years from now.
Right.
That's
not just minimizing taxes every year, but I always think in terms of optimizing taxes. So if we can pay a little bit of tax this year at say 15 or 20% and save paying 22, 24, maybe something higher down the road, I think that's something that that clients should really take a serious look at.
Okay. Number 3 on our top 5 list of mistakes that investors routinely make, and that is, this wasn't a big deal back when we started in 99 because we didn't really have access to it 24/7 like we do today, but that is paying too much attention to your accounts on your phone, on your laptop, watching television. You can make some bad decisions that way.
Right, and I think that, the market's open 5 days a week, 6-7 hours a day. And market history tells you that the market goes up 52 to 55% of days. That's it.
I think that surprises people.
It actually reminds me of, if you recall this, Roger Federer did a talk to a university, did a commencement address to a university. It was in the last year or two. And he talked about, of course, world-class tennis player, right? And he only won a similar amount of points that the market's up. It was like 54% of the time he won the point.
Right.
But yet he's this world-class tennis player, won all these major championships. But the key to the whole thing is being in enough days, right? Enough points, like Roger was.
Right.
But watching it day to day, sometimes the market goes up and down. And you go, I don't know why it went up or down today, right? And you try to justify with, well, this and this and this happened. But then the next day, the same three things happen, and the market does the opposite. And you go, I don't know. It's just daily, as Warren Buffett said, it's a voting machine. Long term, he said it was a weighing machine.
You make a good point, because if you do watch the financial shows, typically during the day and after the market closes, they try to come. They have to earn their money to say, well, let's go to Bob here on the exchange floor. This is why the market did. I'm like, guys, you don't know. Sometimes you do know.
Right.
Sometimes there really is headline news. Most of the time, it's not. Now, if all you're doing is just for informational purposes, and you pick, where's my phone? Pick this little guy up, and you're like, oh, okay, how did I do today? Oh, that's interesting. Okay, knock yourself out. But I think a lot of times what happens is the cumulative effect of this after a while, especially in a bear market.
Right.
It's like, yeah, I'm down now 7 business days in a row. Let it breathe, man. That's where the mistake comes in. All right, number 4, somewhat related. If you look at it too much, you might tend to do this, but this is a big one for me, and that is comparing your own portfolio performance to a benchmark like the S&P 500. Because a lot of times what you'll do is you'll look at maybe and say, oh, wait a minute, the Dow was up 800 points today, and I was only up X. My portfolio must be broken. You're like, wait a minute, you have 60% of your money invested in the stock market. You have all this other stuff. But that's another mistake.
Yeah, the benchmarking that we use in our investment portfolios is always based on the asset allocation of the client, right? And I don't know if any of our clients, I can maybe draw it on one hand, how many are fully invested in stocks. But normally there's a balance, right? There's a balance there. Doesn't always mean that older folks have less in stocks. Some older clients, they have, they're more aggressive in their risk tolerance, but comparing to the indexes themselves is usually a bad game.
Yeah, I think that's one of the ones that gets overlooked. I think a lot of people watching right now are thinking, yeah, I guess I do that. And we'll have clients will say, when I look at my portfolio, what should I be comparing it to, the Dow or the S&P? And I typically would say, well, not really either. Maybe for a portion of it, you might look at a balanced index if you really want to do that. But even that, to me, I think can be dangerous, because your allocation is your allocation. It's unique. There's really not a benchmark. For us, it's all about the long-term financial planning and what the goals are.
Right. I mean, our plans have different benchmarks in them, so that's usually what we focus on.
Right. All right. Last one. I don't know that a lot of people even think about this. Certainly not something that we probably thought about in the early years of our partnership, but it all has to do with liquidity. Tom, take that one.
Yeah, so I think one of the biggest mistakes that investors make is they overvalue liquidity in their portfolio. And so, if historically, we look at private equity versus public equity. Public equity is all the stocks that you can buy on the open exchange. That's only 15% of the number of companies that are available to purchase. Now, most of these private companies, you can't purchase them, but through some forms of private equity and some other alternative investments, private equity typically does between 2 and 4% better per year in returns over, say, a 30, 40-year cycle. Now, people always think, well, what if I need all this money tomorrow? If you have a $5 million portfolio, the only reason that you would need something tomorrow is you've been kidnapped, or even like in death, you don't need full liquidity, right? You don't need full liquidity even when someone passes away. So I think investors typically overestimate the value of liquidity, because I think, hey, how much more of my money can I lock up to get that extra 2 to 4% return if I believe that past performance is going to continue in the future? So that's the one that I thought I'd come up with.
No, I think that's a great one. I will say, the first time you ever lock your money into something that has a 5-year, 8-year, 10-year lockup window, it's hard. We've both done it with our own money. And the first time you do it, but then you see, to Tom's point, you realize, well, wait a minute, that's a portion of my money I knew that I would not need in 10 years.
Right, and typically private valuations don't change as quickly as public valuations. So in 2008, the market went down, 40, 50% that year. Most of the time, companies really, the intrinsic value of the company really didn't change by 50%. It was like just the market, right? People got scared, they started selling things. So the private valuations are usually a little closer to what the actual value should be.
Those are the 5, but I just thought of a question related to this. There's a lot of talk, Tom, about private credit, private equity, a lot of hedge funds. Now they're going to be in 401k plans.
Right.
Is there a little froth there? Any worries in that area?
Yeah, I think it sounds a little dangerous, to be honest. I know that a lot of the big alternative investment companies are pushing this. The administration has been pretty receptive to it so far, but most investors are not really prepared for to lock your money up. And then when you build these products, I don't want to get too technical, but when you build these products, typically a lockup protects the investors. If you remove this liquidity feature, it becomes a watered down version of what was a great product before. So, we'll see what happens, but I'm not a huge fan.
Yeah, I'm not either. I did a podcast on that one too a couple of months ago where I said, if I were king for a day and I could get this thing out of here, I'm not a big fan, but it is what it is. All right, let's end with kind of a State of the Union address, if you will. A lot of people are tossing around the bubble word and saying this is like 99, 2000 all over again. Hey, folks, look, it could be. Nobody knows for sure. I've been doing recent podcasts to say, I'm a little concerned. I wish that we'd get a correction. I don't yet think it's 99 or 2000. Would love to hear your viewpoint. What say you about this?
Well, I'm the big stat guy.
Yes, you are.
This was something that came across my desk that I thought was really interesting. There's been a lot of comparison between what's happening now with AI and what happened in the late 90s with the build out of the internet. Everybody remembers Cisco Systems and WorldCom and all these big companies back in the day that kind of either went out of business or they actually have struggled in stock performance. But if we just go back the last 4 years, earnings growth of those big companies today is up like 75%. The stocks themselves are up about 95%. So it's kind of tracking a little bit, right? So valuations are getting a little higher than they were before. Go back to the late 90s, earnings growth then was 80%, so similar to the 75 that it is now, but those stocks are up over 400%, right? So valuations were so much more extreme. That's not to say that valuations are cheap today. No. They are not, right? That's the biggest challenge that we have, is that I think the S&P is trading at mid to high 20s, 20 to 25 to 28, depending on what you look at, forward earnings. And, earnings are supposed to accelerate quite dramatically with, companies taking on AI and being more efficient, maybe not hiring as many people. But the valuations are a little bit concerning.
Yeah, we don't always agree on everything, and that's the beauty of the partnership, is that we have enough respect where we sit down and say, okay, show me what research you have to back that up, and I'm going to kind of look, and we'll come up with some ideas together. But this is one thing that I think we're on the same page here, in that we're not at the levels of early 2000 at this point. We can get there, though.
Yeah.
I'm not trying to scare anybody, but if we don't get any sort of meaningful pullback here and there, and you get some latecomers who come in, and now bad money, we haven't seen much of that yet, and a lot of borrowing and a lot of debt comes in, and now we're seeing the greed and enthusiasm. You and I then will probably be starting to pull back and get very defensive.
We talk about this all the time. We say, is this 95? Is this 97? Or is this 99, right? In terms of 1995 was kind of the beginning of this nice 5-year run while the internet was getting built out. The NASDAQ really peaked in March of 2000, but the last 6 months of the NASDAQ was just extraordinary. It was like, it really accelerated substantially at that time. So we're watching out for this kind of intense blow-off period that could occur.
If I remember right, I think something like, wasn't it 70 or 80% of money that went into tech stocks or tech funds were like in the last 3 to 6 months of it. And so we haven't seen that yet, but we know what signs to look for. And it's something that you can bet that I'll still write about in my commentary and will occasionally address here on the podcast. The problem here is you've done such a great job. You have. I'm looking at the clock, 20 minutes or so, and you do this with such ease and such knowledge. I'm going to get emails now. I'm going to get comments. You two just need to do this together every time.
Okay.
All right, because you're not busy. You haven't. This guy just sits in his office and doesn't really do anything.
So my thumbs.
I'll just bring you in. We'll do this together all the time.
Maybe we'll do it one more time.
Okay, that's it. Well, buddy, I do appreciate it, man. 26 years.
You bet. Thanks, man.
All right, let's do another 26.
All right, let's do it.
Wait a minute. Well, we'll talk about that another time. All right, everybody, thanks so much. Hey, as always, if you have friends and family and neighbors and people in your office who you think might enjoy these podcasts, especially this one with Tom and I, feel free to send it on, and make sure, as always, that you hit that subscribe button. I appreciate it very much. We'll talk to you again next time.